Beware of higher interest rates and recession. We have ongoing concerns about persistent inflation. Stock prices are at the high end of the range. These are some of the warnings Jamie Dimon discussed in an 80-page letter he released last week. Warnings that don't just apply to the investors of JPMorgan, but are addressed to the entire world.
But they are drugs running through the system, and they create this kind of sugar high, and we're in a sugar high. I think it may bite more than other people.
One of the most important quotes from Dimon's letter is, "We have ongoing concerns about inflationary pressures." That the US, but also much of the world, faces some critical factors that raise the possibility of a second wave of inflation. And the data we've received this year so far has surprised many economists and investors. Monthly inflation measured by the Consumer Price Index has been accelerating since October last year. The latest report from the BLS indicated that prices rose 0.4% in March alone, which might not sound like a lot, but in the first 3 months of 2024, there has already been 1.1% of inflation. We're only a quarter of the way through the year, and we're already halfway to the Fed's 2% annual inflation target. Dimon sees 5 major factors that could contribute to inflation continuing to be a big problem for the economy: fiscal spending, the remilitarization of the world, the restructuring of global trade, the large capital needs for the green economy, and the possibility of higher energy costs. All of these factors continue to play out over multiple years, but one of them is particularly relevant for 2024. In the past, fiscal deficits did not seem to be closely related to inflation. But today, things are very different, because how the US behaves regarding their spending has changed. Take a look at the 1950s to 70s period. The government would bounce between a budget surplus and deficit every few years. They'd run a budget surplus when the economy was booming, collecting increased tax revenues as income and capital grew, and not needing to spend more than they receive in revenue because economic conditions were great. When a recession hits, indicated by the vertical grey bars, the government would run a deficit. Tax revenue would decline as incomes and business profits fell, and government spending would increase to help reignite the economy. And then the cycle would start all over again. That has not been the case for more than 20 years. The US government has been in budget deficit since 2002. The early 2000s recession was quickly followed by the worst recession since the Great Depression. So instead of returning to surplus, the deficit expanded. After 2008, the deficit was being reduced until about 2015, when increased spending drove the deficit back up to almost $1 trillion before COVID had even started. Of course, we all know that the pandemic required the most government support in history, driving the deficit to a whopping $3.1 trillion. The deficits today are even larger and occurring in boom times. The point being that the US still runs a $1.7 trillion deficit despite decent economic growth and a very strong labor market. And what ultimately happens with the deficit is extremely uncertain because this year it's an election year, likely a very close race between parties with 2 very different budget strategies. Biden, if he can keep his eyes open, will likely try to increase taxes, particularly on corporations and the rich, to cover their large spending plans. And Trump, if he can stay out of jail, is likely to provide tax cuts while also cutting government spending. However, just as there are uncertain but important inflationary factors like the budget deficit, there's also some deflationary factors at play as well. I've spoken a lot about inflation caused by an increase in the money supply because it's specifically been a big factor in the inflation crisis so far. What I haven't spoken about is another critical factor: productivity. Productivity in economics is an analysis of how much is being produced by the hours of labor worked. If workers on average are more productive, then costs to the business will be lower, and through competitive forces, prices come down. When I say become more productive, you might be imagining that I'm suggesting people need to work harder and faster, but that's not the only way that the labor force can become more productive. In fact, a much bigger way is through technological advancement. Take the advancement replacement of computing, for example. According to Statistic Brain, in 1980, the cost of 1 gigabyte of hard drive storage was about $440,000. By 2014, the cost was just 3 cents. So the cost of computing has put significant downward pressure on business expenses. But even more valuable is the enormous amount of human hours of labor that's been saved by the increased use of computing and the internet. Imagine a business seeking research to open a new store in a different country. It still requires humans to be involved, but access to incredible depths of data from all around the world instantaneously with the internet saves an enormous amount of money. Or even customer relationship management tools, which can save businesses huge amounts of money through improved productivity and increased sales conversions. And actually, today's video is sponsored by the #1 CRM for medium-sized enterprises, Pipedrive. Pipedrive is the first CRM and intelligent revenue platform designed by salespeople for salespeople. It's a comprehensive tool for helping small and medium businesses visualize their sales processes and improve their efficiency. Pipedrive helps streamline your deals to sales conversion and capture high-quality leads, with their customers achieving on average 28% more deals in their first year using the platform. Pipedrive's tools can be tailored to your business. Take me, for example. I'm running a very unusual type of company, and I'm able to use Pipedrive to streamline my video creating process, customizing project stages and tasks to exactly what I need, keeping me accountable and reminding me of which work needs to be done first. Pipedrive has incredibly easy to use visual sales pipelines, lead segmentation, business analytics, and much more. So if you want to unlock the best version of you and your company's success, please check out Pipedrive from the link in the description below. You can get a 30-day free trial and a 20% discount for the year. The impact of computing and the internet as a deflationary force is very hard to quantify, but it's safe to assume that it's one of the biggest reasons why inflation has been persistently low for much of the last 20 years, even while the money supply over that time quadrupled in size. In 2024, we're on the cusp of one of the biggest technological revolutions in history: artificial intelligence. We are completely convinced that the consequences will be extraordinary and possibly as transformational as some of the major technological inventions of the past several hundred years. Think the printing press, the steam engine, electricity, computing, and the internet, among others. All of those big technological revolutions have automated types of manual labor and reduced business costs. And AI seems to be a way bigger shift than even all of the past ones combined. You might have seen OpenAI announce its new text-to-video AI model, called Sora. This is one of the videos generated entirely by Sora with a simple text prompt. It's of course not perfect, but it's very close to replacing the need for a physical human to go out and record that footage with a drone. And Sora doesn't just solve a stock footage problem. It and similar models will reduce the labor hours all across the media sector, from animations and graphics to logos and other designs. Sora and its inception of text-to-video AI is just one application of AI that we've been able to see and, in some cases, try ourselves. But over time, there will be use cases and problems being solved by AI in ways that we can't even imagine right now. We anticipate that our use of AI has the potential to augment virtually every job. He goes on to write, "We do not know the full effect or the precise rate at which AI will change our business." Again, AI will certainly be some kind of deflationary force over the next couple of decades, but how much of a deflationary force it is and how it balances with the other forces at play is completely unknown. In the letter, Dimon then turns to the stock market. Equity values by most measures are at the high end of the valuation range, and credit spreads are extremely tight. Year to date, the US stock market is already up about 8%, an extremely fast start to the year. And it's largely because investors are just willing to pay more for stocks. It's the same story in the bond market, and we can take a look at this by looking at something called a credit spread. Credit spreads are where we measure the difference in yield between two types of bonds with different credit qualities. such as comparing the return of BAA-rated corporate bonds and AA+ government bonds, which are considered risk-free. The gap, or spread, between these yields has been declining. Why? Well, investors are feeling very confident about the future, and as a result, they're investing more money into riskier, higher yield investments, driving up the price of corporate bonds, which drives down their yield closer to the lower government bond yields.
Confidence is up, there's more M&A chatter, equity markets open a little bit, spreads are getting close to historical lows, which means...
So both the stock and bond markets show us that investor confidence is high. These markets seem to be pricing in a 70 to 80% chance of a soft landing, modest growth along with declining inflation and interest rates. Investors strongly believe that inflation will continue to decline this year and that interest rates will be lowered by the Fed and the US will avoid a recession. Dimon somewhat disagrees.
So when people talk about, the market is kind of pricing a soft landing, that may very well happen, but the odds at 70 or 80% chance we'll have a soft landing. I give it half that. We may very well have.
He thinks the odds of a soft landing are closer to 35 to 40% rather than 70 to 80%. He's certainly not coming out and saying there's definitely going to be a recession, but he thinks the outcome of inflation, interest rates, and the economy is much more of a coin flip. And as a result, he's preparing for a very wide range of outcomes. We are prepared for a very broad range of interest rates from 2% to 8% or even more, with equally wide-ranging economic outcomes from strong economic growth with moderate inflation to a recession with inflation, or in other words, stagflation. But in my view, the most fascinating part of this letter from Dimon is the two warnings that he gives, one for the economy and one for the stock market. He writes, beware of higher interest rates and recession, not just for banks, but for the whole economy. The banking crisis last year was devastating for a handful of banks, but the failures were largely contained to the institutions that faced a very particular cocktail of problems. Extreme interest rate exposure, large unrealized losses in held-to-maturity assets, and highly concentrated deposits. Most of the banking sector, and the rest of the economy for that matter, have been so far able to handle the rate rises that we've seen. But we should be wary of assuming that interest rates have peaked. If long rates go up over 6% and this increase is accompanied by a recession, there will be plenty of stress, not just in the banking system, but with leveraged companies and others. The likelihood of the US achieving a soft landing goes down dramatically if inflation resurges and interest rates go up again. A simple 2% increase in rates essentially reduced the value of most financial assets by 20%. I'm going to visually demonstrate this for you because it can be hard to wrap your head around this. Imagine you have a friend who offers to give you $100, but only in 10 years' time. How much would you be willing to pay him today for that deal? Well, the answer largely depends on interest rates. And specifically, it depends on this formula. With interest rates at 3%, you'd be willing to pay as much as $74 for that $100 in 10 years. The reason why this answer and the formula make sense is because if you didn't take that deal, you could just take your $74, invest it at current interest rates at 3%, and in 10 years' time, that $74 would be worth $100. So at 3% interest rates, $100 received in 10 years is worth about $74 today. Now imagine that interest rates have risen to 5%. That same $100 in 10 years is worth just $61 today. So a 2% increase in interest rates resulted in the deal declining in value by 17.5%. Buying a stock or a bond as an investor is exactly the same thing. You're buying into a stream of cash flows that you'll receive over time. And the price you're willing to pay for that stream of cash flows is in part dictated by the alternative places that you could invest your money today. Rates have been extremely low for a long time. It's hard to know how many investors and companies are truly prepared for a higher interest rate environment. If you enjoyed this video, here's one I did recently where I discussed some other deflationary factors relating to the housing market. And a reminder to check out Pipedrive. It's the first link in the description below.